Imagine you are standing on a quiet, sun-drenched pier just before a massive hurricane hits. The air is eerily still. You notice the tide pulling back way further than it should, exposing the dark, wet sand and flopping fish. This unsettling calm is exactly how Charlie Munger described the moments before a financial disaster. Munger once noted that when 3 or 4 psychological forces act in the same direction, the result isn't just a simple sum. It's an explosion. You probably think you're too smart to get swept up in a panicked crowd, but our brains are actually wired for it. How do these hidden mental shortcuts turn a regular Tuesday into a global economic meltdown? Charlie Munger was the legendary vice chairman of Berkshire Hathaway and a master of human nature. He didn't just want to understand why people buy stocks. He wanted to know why they lose their minds in groups. In 1995, he stood in front of a crowd at Harvard and laid out a roadmap for human error. He called it the Lollapalooza Effect. Most people look at one mistake at a time. Munger looked at how they stack up. Think of it like a chemical reaction. One chemical might be harmless on its own, 2 might cause a little fizz in a beaker, but 5 or 6 different chemicals, that is how a lab bench turns into a fireball. In the world of money, this effect is the ultimate warning sign. It is the moment when psychological biases stop working alone. They start holding hands and jumping off a vertical cliff together. Take the idea of social proof. It is that basic human instinct to follow the herd. If everyone else is running toward the exit, most people will follow without asking why. Now, mix that with the fear of missing out. Add a dash of overconfidence. Suddenly, a tiny dip in the market turns into a free fall. Munger believed these moments were the most dangerous forces in the history of finance. They turn rational investors into terrified participants. Everything feels fine until the math stops making sense. The tension builds slowly at first. Prices climb higher than any reasonable person would expect. People start whispering about a new era of permanent prosperity. But beneath the surface, the structural pressure is reaching a breaking point. There's still a real disagreement on whether these psychological patterns can truly be used to time the market. Some analysts argue the math is just too chaotic to predict. Others insist that human nature is the only constant we have in a world of changing technology. Whatever the side of the fence, the results are always documented in red ink. It is not just about one bad decision at a board meeting. It is about a dozen bad decisions happening at the exact same time across the entire globe. The Lollapalooza effect isn't a single event. It is a resonance. It is like a bridge that starts swaying in the wind until the steel eventually snaps. To see it in action, we have to look at the moments where the world held its breath. We have to see what happens when the logic of the individual is crushed by the weight of the crowd. The process starts with a few quiet whispers in the corners of trading floors. Then it becomes a loud roar in the headlines. Eventually, it is a crash that no one saw coming. Even though the signs were everywhere, nobody wanted to be the first to leave the party. By the time the dust finally settles, trillions of dollars in wealth can simply vanish. You realize the ledge was crumbling long before the first stone fell. The really scary part is that it usually starts with something that feels completely normal. It's a chilly Monday morning in October 1987. Traders in New York are clutching their coffee cups, but their hands are shaking. This is the day the world learned what a true feedback loop looks like. For months, the market had been climbing like a runaway train. People felt invincible. But then, a few clouds gathered over the weekend. On Monday morning, the storm finally broke. This wasn't just a bad day at the office, it was a total breakdown of the system itself. In the 1980s, a new trend had taken over Wall Street called portfolio insurance. The idea was simple. If prices fell, the computers would automatically sell stocks to protect the investor. It sounded like magic, but there was a massive flaw in the plan. Everyone was using the same strategy at the same time. When the market dipped, the computers all hit the sell button together. This created a waterfall effect that no human could stop. The Dow Jones Industrial Average plummeted more than 20% in a single session. To put that in perspective, imagine a fifth of the entire country's wealth disappearing between breakfast and dinner. It was enough money to build a bridge across the ocean made of solid gold. The trading floor became a scene of pure desperation. Phones were literally ringing off their hooks. People were screaming orders into the void, but there was no one left to buy. This is the Lollapalooza effect in its most violent form. You see the collision of automated fear and human panic. The computers were acting on logic, but the humans were acting on survival instincts. Social proof kicked in with a vengeance. If everyone else is selling, staying in the market feels like standing in the middle of a burning building. It creates a vacuum where the price has no bottom. The tension reached a peak in the afternoon. Rumors started flying that the New York Stock Exchange might actually shut down. People were worried that the entire global financial system was about to disintegrate. Every time the ticker updated, the numbers were worse. It felt like watching a car crash in slow motion, except the car was the global economy. It was a moment of total uncertainty. Finance people still go back and forth on whether the computers or the humans were more to blame. Some say the tech just accelerated a crash that was already coming. Others argue that without those automatic sell orders, the day would have been just a normal correction. Regardless of the cause, the impact was undeniable. The crash wiped out roughly $500 billion in market value in a matter of hours. Eventually, the Federal Reserve had to step in. They promised to provide the cash needed to keep the system moving. It was a desperate move to restore confidence. By the next day, the bleeding mostly stopped, but the scars remained. Traders realized that the market wasn't just a place for math. It was a giant interconnected web of psychology and technology. When those two things clash, the results are unpredictable. The lesson from Black Monday is clear. Even the most sophisticated systems can fail when everyone tries to crowd through the same door. It showed that the Lollapalooza effect doesn't need months to build. Sometimes it just needs a few hours and a lot of scared people. The ghost of 1987 still haunts Wall Street every time the screen turns red. You realize that a system is only as strong as the collective nerves of the people running it. The late 1990s were a wild time. The internet was changing everything. It felt like the rules of gravity had been cancelled. Companies that didn't make a dime were suddenly worth billions. You look back and see a world obsessed with a single phrase: the new economy. It didn't matter what a business actually did. If it had a website, it was considered gold. This was the era of the day trader. People were quitting their jobs to click buttons in their living rooms. Charlie Munger's Lollapalooza was working overtime during this frenzy. First, there was the incentive caused bias. Founders and venture capitalists were making millions on paper overnight. This created a massive incentive for everyone else to jump into the fire. Then, social proof took the wheel. Your neighbor was getting rich on tech stocks. Your barber was giving you stock tips between haircuts. It felt like being the only person at a party who wasn't drinking the spiked punch. The Super Bowl in 2000 was the peak of this madness. More than a dozen dot-com companies bought expensive commercials during the big game. One famous ad featured a sock puppet for a pet supply website called Pets.com. That company went from a high-profile launch to bankruptcy in less than a year. It was a classic example of burning cash just to stay in the spotlight. The tension was thick because the math was clearly broken. Prices were going up, but earnings were non-existent. Then, the bubble finally popped in March 2000. The Nasdaq had doubled in just 1 year leading up to the peak. But once the selling started, it didn't stop for 2 years. The confidence that held everything together evaporated in a few weeks. It wasn't just a dip. It was a total wipeout for thousands of companies. Trillions of dollars in paper wealth disappeared like smoke. People who thought they were retired suddenly had to go back to work. Analysts still argue about whether the dot-com crash was a necessary evil for tech to grow. Some say it cleared out the garbage so the real giants like Amazon could rise. Others believe it was a preventable disaster that ruined millions of innocent lives. The drama of the era was fueled by a new era mindset. People convinced themselves that old-school metrics like profit were dead. It was a dangerous form of collective denial. The Lollapalooza effect happened because multiple biases were pulling in the same direction. Greed was high. Fear of missing out was even higher. And the authority figures in the media were cheering it all on. When everyone agrees on the same lie, the truth becomes very expensive. The crash wasn't just a market correction. It was a psychological breakdown of a global scale. Looking at it now, the signs were obvious, but in the heat of the moment, the momentum felt unstoppable. Munger often said that it is hard to be a rational person when everyone around you is losing their mind. The dot-com era proved him right. It showed that technology changes, but human nature stays the same. The same patterns of euphoria and panic just find new ways to dress up. It becomes clear that when the crowd is most certain, the danger is most real. Fast forward a few years and the world had a brand new obsession. This time, it wasn't shiny websites. It was suburban houses with manicured lawns. You might remember the feeling of that era. It seemed like everyone was becoming a real estate mogul. People were buying second and third homes with almost no money down. The general wisdom was that housing prices simply never go down. This was the foundation for the biggest Lollapalooza event in modern history. It was a toxic cocktail of bad incentives and misplaced trust. The math behind the 2008 crisis was incredibly complex, but the psychology was actually very simple. Mortgage brokers had a massive incentive to sign up as many people as possible. They got paid their commission and moved on. They didn't care if the borrower could actually pay the loan back. This is the definition of incentive cost bias. At the same time, the big rating agencies were labeling these risky loans as safe investments. They were the authority figures that everyone trusted. When you combine those bad incentives with that blind trust, you get a bomb with a very short fuse. The tension finally snapped on September 15th, 2008. That was the day Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in American history. It sent a shockwave through the global economy that felt like a literal earthquake. Suddenly, the money that keeps the world turning just stopped moving. Banks were too afraid to lend to each other. Even giant companies struggled to get the cash they needed for daily operations. It was a moment of pure, unadulterated panic. Reports from the time described a world on the brink. Treasury officials were working through the night to prevent a total collapse. There was a very real fear that if you went to an ATM, no money would come out. This wasn't just a stock market dip. It was a systemic failure. The psychological forces of denial and overconfidence had finally hit a brick wall. The Lollapalooza effect had reached its peak. It wasn't just one bank failing. It was the realization that the entire structure was built on sand. Economists still debate whether letting Lehman Brothers fail was a necessary lesson or a catastrophic mistake. Some argue that a bailout would have created even worse behavior in the future. Others insist that the move almost destroyed the modern world. Either way, the fallout was devastating. Millions of people lost their homes. Trillions of dollars in retirement savings vanished into thin air. It was a brutal reminder that when the crowd is wrong, they are usually wrong together. This crisis showed how the Lollapalooza effect can hide in plain sight. Everything looked fine on the surface because the prices were still high. But beneath that surface, the psychological pressure was building for years. People were ignoring the red flags because everyone else was ignoring them too. This is why Munger was so obsessed with these patterns. He knew that the most dangerous risks are the ones that everyone agrees to ignore. The 2008 crash changed the way we think about the economy forever. It proved that even the most stable assets can become dangerous when they are fueled by mass delusion. The drama of those months in late 2008 is still studied in every business school. It serves as a grim warning for anyone who thinks the market is always rational. You see the same patterns repeating over and over. Only the names of the assets change. The human heart stays exactly the same. The world moves faster now than Charlie Munger could have imagined when he first coined his famous term. Today, you carry a casino in your pocket. With a few taps on a smartphone, anyone can move thousands of dollars across the globe in seconds. This speed hasn't fixed the Lollapalooza effect. If anything, it has given it a massive dose of adrenaline. High-speed internet and social media have turned the old-school whisper networks into global shouting matches. You might remember the mania that gripped the markets in the early 2000s. It was a textbook example of how the same old psychological traps just found a new playground. The 2021 meme stock craze was a Lollapalooza for the digital age. It started on internet forums where thousands of retail investors decided to take a stand against massive hedge funds. The primary target was a struggling video game retailer called GameStop. On one side, you had professional investors betting the stock would crash. On the other, a massive army of individuals using apps like Robinhood to drive the price into the stratosphere. It wasn't just about the money anymore. It was about social identity and sending a message. This created a massive collision of psychological forces. There was social proof on a scale never seen before. Every time someone posted a screenshot of their massive gains, thousands more jumped in. There was the liking, loving tendency toward the community leaders. And there was a massive dose of envy as people watched their friends become millionaires overnight. The tension peaked in January 2021 when the stock price of GameStop went from roughly $20 to nearly $500 in just a few weeks. The drama reached a breaking point when several major brokerage firms actually restricted trading on these stocks. They claimed they didn't have the collateral to handle the massive volume. This move caused a global outcry and led to multiple congressional hearings. It was a verifiable event that showed just how fragile the plumbing of the financial world really is. When the music stopped, the price crashed back down, leaving many latecomers with massive losses. It was the same story as the South Sea bubble or the dot-com crash, just condensed into a single month of frantic scrolling. There's still a real disagreement on whether these social media-driven surges are just random noise or the new normal for global finance. Some analysts believe that the democratization of trading has fundamentally broken the old models. Others argue that it's just the same old human greed with a faster user interface. Whatever the case, the mechanics of the Lollapalooza effect remain undefeated. Munger spent his final years warning that the combination of high-speed trading and aggressive incentives was making the market more dangerous, not less. Charlie Munger passed away in late 2023, just shy of his 100th birthday. He left behind a legacy of clear thinking in a world that often prefers noise. His Lollapalooza concept wasn't just a fun word. It was a plea for people to look at the big picture. He wanted us to see how our own brains can be used against us when we stop thinking for ourselves. You see the same mechanics playing out in the crypto markets and the recent AI boom. The names change, but the collision of biases stays the same. The real takeaway from Munger's life is that you don't have to be a genius to succeed. You just have to be slightly less insane than the crowd. By recognizing when multiple psychological forces are pushing everyone in the same direction, you can choose to step back. You realize that while the tools of finance change every decade, the human heart remains exactly the same. The next Lollapalooza is likely already building somewhere in a quiet corner of the market, waiting for the right spark to turn into a bonfire. It's been quite a journey through the highs and lows of financial history, hasn't it? We've seen how simple human instincts can stack up to create some of the most chaotic moments in modern memory. It makes you realize that the economy isn't just a series of charts and spreadsheets. It's a living, breathing reflection of our collective hopes and fears. I'd love to hear from all of you in the comments section down below. Where are you watching this from today? The world feels like it's moving faster than ever, so I'm curious to know how your local economy is treating you and what your plans are for the coming year. If you enjoyed diving into the mind of Charlie Munger and exploring these market mysteries, please consider hitting that like button. It really helps the channel reach more people who are looking for a calmer way to understand the world of money. And if you haven't already, subscribe and turn on those notifications so you don't miss our next deep dive into the stories that shape our world. We have a lot more ground to cover, and I'm glad to have you along for the ride. Thanks for spending some time with me today. Take it easy, stay curious, and I'll see you in the next one.